Hello, hello. So today we're going to talk about value creation. You can call it strategic growth. You can call it transformation, innovation. Actually, the bottom line is to increase the enterprise value of an asset. So my name is Peggy from the Plassche. I spent a lot of time actually working in value creation, no matter how you want to call it. And this edition is really about my personal playbook about the past 25 years to value creation. And if you're connected to the space of private equity, you have probably seen an evolution of the way private equity approach value creation over the last 25 years. And it has become way more operational. I mean, at least among the top players. So it really evolved from what I would say was put a shitload of debt on the business and cut costs drastically to building, teams of operational partners, or again, call them portfolio managers, call them value creation experts, but people who are spending their days helping companies in portfolio increase their value, because obviously the goal is you buy at a price X, and when you sell 5, 7, 10 years later, hopefully that price is a nice multiple of what you bought. That's how you create return for your investor. So that is why value creation is more important than ever. And let's be honest, there is still a long way to go. I see a ratio in average of 3 investors in private equity for every 1 value creation expert. So that still gives you an idea of where the industry thinks the value is. You also see compensation structure very often that are on a different grid, meaning investors being compensated more than value creation experts. Which obviously makes it a bit more difficult to support the value creation agenda. And, to be clear, the evolution of financial engineering versus operational value creation wasn't driven by a sudden desire to do better by businesses. That wasn't coming from the good heart of private equity players. The shift was really forced on them by economics. So if you think about the interest rates that were at near zero, they're gone. So the easy money that was fueling and that fueled mega funds, that fueled sky high valuations, and again, the financial engineering, all of that has vanished. So now, obviously, you have more volatility, we have trade tensions, we have tariff, the growth is slowing, and well, the cracks are showing. So there is less and less options for private equity players if they want to return capital to their investors than to actually create value through operational improvement. So again, what I want to say is that the challenge is not that private equity no longer works. I've seen articles like that. I've heard some comments like that. I really don't think it's the case. I think it's more that the rules have changed and most players have not. So it's not working because we have not understood that now the game requires more work. and that's just the reality. Exits are harder. Continuation funds, so these funds that had been put in place to kind of pass on assets from one fund to another because exits are not possible, are almost like necessary lifeline. But I mean, investors are not crazy about that because they obviously want at some point their distributions, they want return. So the LPs, the investors are asking more and more questions and tougher questions because again, they are getting eager for getting their money back. So in this environment, value creation is not just this buzzword, it's really about survival. And I'm not just talking about, what you've probably heard, cost cutting, synergy capture, which is usually very superficial and, something that's not really moving the needle, to be totally honest. We're talking about like real operational value creation. So think about, launching new revenue streams, serving your clients in smarter, more digital and more profitable ways, using AI. Actually, we have already a lot of tools. We don't need to wait for another 5 years of development. Tons and tons of tools already exist today. These are not R&D dreams. And we can use that to really boost, again, whether you call it precision, outcomes, streamline processes. There are a lot of usage I see today from AI tools that are absolutely not leveraged. And obviously, you can embed more and more technology. AI is one of them. At the core of transformation. Usually, it's more at the periphery. That's what I see. So too many portfolio companies actually they still run like it's 2005. But like if you look at the top PE firms, the ones that really embed digital strategy, and operational excellence really at the center of their playbook, they're going to be the ones who will be able to deliver the returns, and they're going to be the ones who will earn the right to raise again. Because obviously, if you're a PE players, and I'm not talking from pension funds, but if you are a standalone PE players, if you're not returning capital to your investors, well, at some point, it's going to be very difficult for you to fundraise again. So you really, really have to be mindful of that. So again, private equity is not dead, but like the easy multiple expansion party that is over. That's not happening. And maybe in the future we'll have again interest rate at zero, blah blah blah. The new boom and bust cycle will start again. We know the story. I've seen that movie before. You've seen it too. But right now it's absolutely not the case. So it's really time to get back to building businesses, like intelligently, strategically, creatively, instead of hoping for financial engineering. And I mean, some top-notch funds were already doing that 20 years ago. What I'm talking about is not something that is radical. But now some are discovering it, and they're discovering it the hard way. So yes, again, PE is in trouble, and same old will not cut it. So I've been in value creation, again, or transformation, innovation, call it as you want, for pretty much my entire career. And I've always taken a lot of pleasure and pride, I have to say, in maximizing the value of an asset. I love that intellectual challenge. I love to be able to connect the dots between things I've seen maybe in other industries, and really enjoying working with a management team. But over the last 25 years, I mean, I've seen the good, the bad, the ugly, and I want to share some experiences that hopefully is going to give you some insights as well for your own business, or maybe you are yourself a private equity player. And again, always happy to chat, but here is some of the highlights of my experience in PE. So I started my career in France, as I'm sure you know, and if you don't, you can hear that. I'm from France originally. And right of business school, early in the early 2000s, I worked in finance. I worked in finance at a company that was called United Biscuits, a snack manufacturer. I'm sure you would have, guessed that with a name like that. And it was in France, and it was owned by Blackstone and PAI Partners, which is a European fund. So they co-own the organization. And it was really my first exposure into private equity via a portfolio company. And I have to say, I couldn't help but really admire the discipline. We went through every line of the P&L balance sheet and linking it to value creation initiative. And I say value creation, not just cost cutting. I know that private equity has this reputation, but yes, we did cut costs, but a lot of these savings were actually directly reinvested in the business. So as a few examples, we improve packagings. Yes, we use cheaper material, but we also made the design trendier and more fun. We automated and we expanded production lines. We increased our global footprint. That's actually where I heard about Costco the first time in my life. That's when I was there because we were selling a lot to Costco. We upgraded the ERP system. We brought technology to the manufacturer, to the shop floor. So we've done so much in this organization. And again, it was for me very interesting to see that. I was responsible actually for tracking and reporting the progress of, dozens of this project to the management, meaning I had to understand each one in detail. And if something was late, if something was not delivering what they were supposed to deliver, well, I had to be on top of that and understand what was going on and have a remediation plan. So this really was my first fire test in operational value creation. And that experience really sharpened my interest in the space and gave me this first-hand exposure to what the best PE firms can bring to their assets. And it really challenged, this, I would say, lazy stereotype that private equity is only about debt loading, pension rates, and layoff. What I saw was really thoughtful, highly structured. It was all about growing the value, with strategic reinvestment, with clear governance, with disciplined execution. So for me, that was really a fabulous experience. Then I moved to Canada and I worked at CGI. So if you don't know CGI is a very large technology company that was founded in Quebec. It's Canadian and very successful. I think now they must be around for like 45 years. And obviously, CGI is not a private equity firm. It's an organization, as I say, a tech company. But the management understood very well how to grow enterprise value. And that I thought was extremely interesting. So it was my first foray into tech. I was absolutely not a tech person. And to be honest, I was afraid and not interested by tech, which is ironic now considering that it's also my bread and butter. But at the time, I really don't like that. And around 2006, if you looked at CGI, it was positioning as a service company, what some people would call the body shop. So they would provide 5, 10, 500 consultants for some projects or some operations. And that was really their bread and butter. So they were service. But they own actually a suite of software solutions that was very expensive. Expensive. And these solutions were used everywhere. From defense, from the US federal government to major North American banks. I've seen software in every areas. And at the time, the new CEO came on board. So prior to that, the founder, Serge Godin, was the CEO. And then in around 2006, I believe, Mike Roach took the top role. He was COO and he became CEO. And he saw what others didn't. He saw the gold mine of these undervalued software assets. And he also saw that the stock price that CGI had, which was not extremely excited, to be honest, didn't reflect this potential. So I was hired as part of a SWAT team to really rethink and change the software strategy. So we restructured delivery models to grow recurring revenues. If you know that means higher multiple. We automated and offshored low-value activities. We made tough calls on where we wanted to double down on the investment for the solutions and where we needed to sunset. Anyway, we really, really work with each businesses because each software had obviously their own P&L, and they were, you can look at that as independent company almost in the company. And so we were working with each, exactly like a PE firm actually, we were working with each of these companies, helping them reposition their business that would prop up the multiples of the organization. So it was not really bottom up, but it was assets by assets. So, and I mean, this approach worked, and the company really created long-term value. The stock climbed, which, my stock options benefited too. So I was quite happy with that. But what stayed with me was really how powerful the combination of strategic independence, as I said, each of these different businesses, like we're working as a one business, if I can say that, and the combination of this independence with operational discipline really brought, incredible results. And what I really, really love is that CGI really showed that this kind of value creation doesn't require external consultants. We didn't outsource the brain work. We did it all in-house. So we didn't end up with knowledge leakage. We didn't end up with, future competitors that were trained on a dime. We didn't have 7 or 8 figure consultant invoices. We did everything inside. And one of CGI's great strengths was its ability to apply PE-like portfolio logic within a corporate structure, which I don't think is that complicated when you think about it, because when you're in a large organization, it's, very often the sum of multiple businesses, but this is not usually how businesses operate. So CGI was really looking at each of its business lines, not as just a cog in the big system, but as a standalone value driver, with their own metrics, their own leadership, their own performance levels. And the head office didn't comment, it enabled. Yes, we being corporate, I was my SWAT team, we were in the corporate office. We had to work with them on their business case when they wanted capital infusion. We really review how they were changing their business model in order to grow and expand the multiple. So we work with all of that on them. But at the end of the day, they were the one putting in place this different measures. So it was really extremely well done, and it was a very fun time as well. I spent 6 years there, and really that was super fun. After that, I spent, as you might know, many years in financial institutions. And that was a huge contrast, because what I saw was that the idea of managing businesses as independent value drivers just is not how banks and insurers operate. Whether they look at the business as a whole from a top down, which is too macro to do anything because it's way too big and too complex, or too micro, and that is just the amalgamation or small projects. So for example, you see that the annual strategy reviews or the take capital allocation, it happens by business unit, and then it's rolled up to a company-wide view. But these business units are so large and so fragmented that it ends up becoming an amalgamation of micro data points. So you have hundreds of small projects. Everyone is putting a small project in the queue to get money, and the sum of all these projects become almost the strategic view of a business unit. So basically there is no middle. So whether you amalgamate everything and that becomes your company view, but it's coming from such a micro bottom up with no connection in the middle, but there is actually no connection to value creation. So I mean, the result is really like a mountain of information tons of reporting, massive resource allocation for processes that really don't tie to value creation. I mean, it becomes a business as usual with incremental improvement at best. So it's really the way I saw the value creation, or maybe the lack of value creation mindset in financial institutions. And there is also another pattern I saw in financial institutions. When I say financial institutions, that can be banks, that can be insurance, you understand what I'm talking about. So there is also a pattern I saw. It's like these big bang transformation plans, usually led by consultants. So that can be keep only 6 levels of hierarchy, save costs by firing the middle management, for sure, or useless. Or massive tech overhauls that, fail quietly when the system glitches and we all have to revert to Excel. So that's whether it's massive program, or it ends up being micro level cost efficiency effort. So again, these hundreds and hundreds of projects where everyone save 10 grand here, 50 grand there. And again, just incremental, So and I say rarely see, what I've never seen, let's be honest, is a value creation approach starting from this simple but powerful question. What are the metrics that drive enterprise value in this business? Again, even if it is not a standalone company, the question still applies. Let's take the asset management group of a large bank, for example. What if that business was spun off tomorrow? Or would it be valued? And then, and only then, should we look at the levers of value creation with that end state in mind, as if we were exiting. So versus macro or micro entry point. So I think that's something that CGI was extremely good at. They gave business lines autonomy, but with discipline, with guidance, and friction. We were not always in agreement, let's be honest, and that created a healthy tension, but also accountability. And these are not necessarily traits that align with the financial institution culture. That's the reality. So the challenge is that if you really want value creation, you're going to have to deal with, again, tension and accountability. I mean, that's the price. So I think it's a big missed opportunity in financial institutions. The way we budget, the way we don't really look at value creation, we look more at incremental improvement, but never at what could be done, unless there is suddenly a competitor that's doing something and then everyone is following. But otherwise, it's very, very flat, I would say. So I also worked in ton of other industries, because I have my own advisory business, so I work with many clients. But also, I've had jobs in other industries. So, I mean, after really working for years with companies of all size, I work with big companies, I work with very small companies, but also across multiple industries. I kind of develop several go-to litmus tests. And because I've done a lot of digital transformation work, that's really, I would say, my sweet spot, my secret sauce, my bread and butter, whatever you want to call that. My eye tends to go there, and especially that, let's be honest, digital transformation is usually where the most value is hiding. That's the reality. So what are some of these questions that I'm looking at systematically, because it's going to quickly give me an idea of where there could be a pool of value creation that have not been explored. So first question I'm asking myself is, are the founders highly technical? So that can be, if you're in healthcare, like scientists, if you're in technology, obviously a technologist. And are these founders, if they are highly technical, are they still involved in the strategy? Because if they became a chief product officer, or maybe they became chief scientific officer, that's less of an issue. But if they're still CEOs or if they're very involved in the strategy, well, usually what it means is that too much capital is going to the product development, and not enough in commercialization. Because very often these are people who are in love with what they're doing, which is great, but that means that they might develop a lot of things that are not necessarily needed in order to sell. And if they have to allocate $1 million, you're going to have a big chunk that is going to be going to product development versus commercialization. So again, just based on the background of the founders, I can already have an idea of, oh, there's probably something where we spend too much money on product development and not enough elsewhere, especially commercialization. So that's my test number one. Test number two, is the chief technology officer or the chief information officer, depending on how it's called, homegrown? Meaning, is it someone who was in the organization 20 years ago and has moved up the rank? If it's the case, I tend to see a lot of opportunities with digital transformation. Whether it's like new offerings that can be done with the right technology, whether it's efficiency, whether it's customer experience, think about digital agents, things like that. Because very often a CTO or a CIO that was homegrown has not really seen what can be done elsewhere. And as much as they have a great knowledge of our organization and probably great relationship with people, they are probably not as familiar with digital transformation because they probably haven't seen it in their own organization. So that is something as well. That's a second test. Where is your CTO coming from? Does he have huge experience with new tools, digital transformation? If the answer is no, probably an opportunity there. Another question is, where is the company located? So if the company is located in Israel, in the US, I know that it's likely that they're going to be strong in commercialization. Usually these are countries and people who are very strong with sales and marketing. If it's located elsewhere, Canada or France, anywhere, very often that's going to be a weak spot. So that's something, again, I'm like, it's not about red or green flag, but it's like, I'm taking a note. I'm like, okay, something to look at. Another question is the cap table. And if I look at the cap table, the capitalization table, meaning who invested in the company, and I see the company is bootstrapped, that means they didn't take external capital or they took very small amount of external capital, I know it's going to be a capital efficient company, meaning they have managed their cash very smartly, usually, and I would not see a lot of expenses that can be cut. But the firms that have raised very large VC rounds, especially when interest rates were at zero and the markets were flush with cash, well, very often these companies are not capital efficient. So there will be a lot of things that can be looked and relooked and improved because it's probably not necessary expenses. The last question that I want to mention is where are they in their life cycles? So is it a Series F, so late stage company, or is it like a mature company, stable business? They both have transformation potential, but it will be a very different kind of transformation potential. So if I look at more mature company, a digital transformation is often like really the priority for them, like a lot of opportunities. A company that is Series F, that might have been around for 10 years, they were probably already integrating a lot of the new tools, and they're probably more on the ball when it comes to technology. So that's another question you can look at. So there are a few things, and again, I've done that for 25 years. So it took me 25 years to take me 5 minutes to think, okay, here there are opportunities. I mean, that's how it works. Like so that's what Picasso was saying. Took me 40 years to be able to do that in 2 minutes. That's just the reality. So ultimately, really, when we think about value creation, seems obvious, but it starts with the exit in mind. and a clear understanding of what multiples are used and are going to be used in that industry. That is what matters. That's the only thing that matters. It's a bit like you're buying a house, location, location, location. Yes, of course, the size of the house, the renovation, all that stuff. But what is the most important aspect of real estate is the location. But it's the same for a company. What is going to be the 2-3 most important aspects in order to sell that business at a better enterprise valuation, but when it was about years prior. So again, the most effective value creation experts, so these people who are working whether in private equity, as operational partners or value creation, whatever you want to call that, or sometimes within an organization, you also have some of this team, like what I was doing at CGI, not often, unfortunately. So the most effective people, they combine what I would call horizontal and vertical expertise. So, for example, if I take myself as an example, it will be in terms of industries, okay, healthcare, financial services, technology. That will be like the vertical, but I would layer in expertise such as digital transformation. Someone else might be having, might be having, like manufacture and retail, and have sales and marketing reinvention. So you want to have industry, but you also want to have expertise, in specific areas. I think the big challenge of having SMEs, like subject matter experts, is that people don't necessarily have seen enough playbooks. So if you've done only healthcare, okay, maybe you're an expert in healthcare, but the challenge is that you cannot connect the dots with things that might have happened in other industries. And if you're a generalist specialist in healthcare, but you don't have a secret sauce with, again, digital transformation, sales and marketing, maybe HR, or things like that, well, you don't really bring a lot of value in terms of transformation. That's just the reality. You still need to have seen multiple playbooks and know how to adapt them, not just repeat them. So again, value creation, it's not about theory. It's really about connecting the dots between real world outcomes. That's where you're starting with. And today I'm in the reality, and I know that's where I'm in, so it's easy for me to say that, but digital transformation, and whether you call it AI, you call it doesn't matter, technology, that is often where you have the most value. That's just the reality, it's today that's it's going to improve your top line, it's going to improve your bottom line, it's going to improve your client experience. I mean, it's really the area. If there was one area I would focus, that would really be digital transformation. So thank you so much for listening and watching. If you're looking at that video on YouTube or elsewhere, if you have any questions, don't hesitate. I love talking about that. That's I think a very, very fun topic. And again, thank you for your time. And you can check my website, which is peggyvandeplassche.com. Thank you so much, and talk to you next week. Bye-bye.